Aspen has delivered positive half-year results, reporting strong performances across all segments of the business. However, the rand's strength against all of Aspen's trading currencies over the period significantly diluted the reported performance when compared to the underlying constant exchange rate performance. Stephen Saad, who is CEO for Aspen, joins us now with more on the performance. Thank you so much for your time, Stephen. I do understand that the stronger rand made the numbers less shiny, but paint a picture of the level of growth you saw excluding that impact.
Yeah, so the growth in our EBITDA was over 20%, it was 21%. And our headline earnings were up by 17%. So it was a strong performance in currency, as you said. I must make just this comment. In all the years that we have reported in constant exchange rate, there's not a single year that I can remember where the rand was the strongest currency against all currencies, including the euro and all our trading currencies. And it was amazing, even in a period where, you know, there's been the American policy towards emerging markets and South Africa hasn't been great. We still were even stronger over this year than the euro. But, you know, currencies like the Latin American currencies all came under a lot of pressure. I think every time we breeze 25% at Mexico, there's something goes, you know.
Very interesting dynamics that are happening there on the currency scene. I'm just looking into your different divisions, Stephen. I did notice that manufacturing revenue declined, and the main culprits there were the heparin and API businesses. But would you say that this is the worst of it for the year?
Well, the manufacturing did decline because in the prior period, we sold a whole lot of heparin stock. However, the manufacturing business itself, the EBITDA more than doubled. So that's why you get a much bigger jump in our profit than our revenues across our group, is because the manufacturing really kicked in for us. The finished dose form, our sterile manufacturing business, really kicked up. So yeah, flat revenue, but a very strong growth in profits, more than double.
And in terms of the usage of your manufacturing capacity, what levels are you looking at there?
You know, South Africa is still very underutilized, and in time, you know, to increase that utilization, we need to be successful in our transition with the insulins and to get our products registered across Africa, the pediatric vaccines. Our French site is more than 50% utilized, and it was a big contributor in the profitability in this period. So I think we've got the contracts in place to grow. We've still got more capacity that we can utilize, but I would say watching the South African capacities increase over this next period are very important for our manufacturing capacity utilization increases will be very important to profitability.
Well, Stephen, all the buzz is on GLP-1 drugs. Talk to me about Aspen's. Of course, you know I have to ask. Talk to me about Aspen's role in that manufacturing and distribution chain and really the anticipated growth momentum from this division.
Yes. So I've never had so many new friends as of late. So we've got two different types of entries into GLP-1 market. The GLP-1 is the diabetes, the weight management products. In South Africa, we are the agent for Lilly, so we launched the branded product, which was Mounjaro. And I've been in the South African market for a very long time. And in all my years, I've never seen a product. This will be the largest product, in my opinion, that the South African private market has seen. We only launched it in February. We had to put stock in December and January for the launch. Before we even launched it, already had nearly 20% market share. So that was the demand for it in South Africa. So that's how one opportunity is being the Lilly's agent for Africa or sub-Saharan Africa. The second opportunity is making generics of GLP-1s that are these products that are coming off patent globally. And that process starts from 2026. And there we're in a really good position because one of the key things is there's a patient pool of over 1 billion between people that are obese and with diabetes, and market's completely constrained for volumes, as you know, and they're only treating between 15 to 20 million patients. Aspen's in a very fortunate position of having the foresight to build sterile manufacturing capacities. So we have the capacities. Most of the early markets on emerging markets, we have strength. And so our key deliverable was to have intellectual property that we could use and own ourselves and deliver. And that's where we've made fantastic progress after the last 6 months. And one of the strictest regulators had already given us a response on our dossiers, which gives us a good sense that we'll get the products registered. And that income we would see coming in from 2026. And we see that as a really big opportunity for both our commercial business and our manufacturing business.
All right. Well, let's cross over to China, the Sandoz business there. You did see higher costs and there is a reshaping underway. What is the vision of that and cost to get there?
Yeah, so China has always been a very strong market for Aspen historically, and then we were impacted with the central procurement policies. It's called NVP, so it's a VBP. It's volume-based procurement, but we waited for the market to rebound, and actually the Chinese market has not rebounded as we had hoped or envisaged. So when we took the Sandoz business, put it together with Aspen, we had expenses from both businesses, and given that it's going to require a significant reshape in the expense base to play what we see in front of us. And what we see in front of us is we're not seeing a rebound in the Chinese market in the time that we had initially envisaged.
Yeah. And Stephen, just...
That we should be in China is a no-brainer. It's a massive market.
Yes.
But we also need to go in with the right shape. You can't be hemorrhaging in them.
Well, talking about shape, so let's go into your balance sheet as we wrap up the conversation. Would you say that Aspen is sitting pretty even with increased debt and finance costs?
Yeah, so the finance cost increases are largely a function of increasing interest rates. We always have a stronger second half, which we anticipate in this year as well, which means we build stock up to the half and then we draw down. So we have strong cash flows in the second half, and that will perpetuate. And our debt relative to our overall EBITDA is probably 2.5 and dropped to 2.2 or 2.3. So it's not high debt. It's not high debt on a relative basis to earnings. And it's got to be seen against the fact that we've made some very big and continue to make some big investments in our CapEx just to be ready, for example, for this GLP-1 opportunity. All
right. Well, thank you so much for your time and giving us insights on those numbers. Investors also reacting pretty positively. The last time I checked, that share up at 12%. That was Stephen Saad, CEO of Aspen.